Folks, in an absolutely shocking turn of events, investors just turned bullish on the stock market for the first time in a very, very long time. This market has been overwhelmingly bearish with sentiment for literally pretty much about 18 months now at this point in time, and we just flipped to bullish on sentiment, okay? A lot I want to take you through in today's video. We've got to talk about positioning a portfolio moving forward now that the market has officially flipped bullish in terms of sentiment. It looks to me like the debt ceiling deal pushed a lot of these bears overboard, and they said, you know what, I'm done short in this market. I'm done buying puts. I'm done being bearish. I'm starting to flip over to the bullish side. And so I want to take you guys through positioning for your portfolios later on in this video. Something very important. We've got to talk about hedging. I want to give you guys some strategies, some things you could potentially implement in your portfolios if you see fit that might make sense, because I know a lot of you guys are running around out there and making a lot of money and congrats. And, you know, as somebody that's made, oh gosh, I might be at 7 figures this year. I don't know. Okay, it's a big number. It's been a phenomenal year. But we do have to always think about the risk on the other side of this game, right? And I want to take you through some of that today. So hope you get a lot of value out of today's video. Hope you really enjoy this one. Pay very close attention to this video because we got some important things to talk about, okay? So there's a shocking change, folks, because literally just last week, we were at about 29% of market participants were bullish on this market. To jump up to 44% is shocking. I mean, that is simply shocking. You don't usually see a move that dramatic flipping bullish. You can see it bearish if something comes out of nowhere, like Rona, for instance, right? Something so shocking, SVB, something so crazy that it just comes out of nowhere and everybody's like, what? Obviously, Russia, Ukraine, something like that, right? But to have that almost 15 percentage point difference, it's shocking, right? Over 15 percentage point difference on a week-to-week basis. That goes to show you like how dramatic this really was, right? We're now at a 1-year high for bullish activity. Our 1-year low, by the way, or 1-year bearish, high for sentiment, right? Which was kind of like the lowest point for sentiment on the market was back late September. And something, I think is interesting in regards to that is, let me show you something extremely interesting. Because you got to ask yourself, it's kind of like what came first, the chicken or the egg, right? So what comes first? The market going up or the market going down to push bullish and bearish narratives? Check this out. This is dramatic, okay? Look at this. This is since late September when we hit the worst sentiment on the market, right? And look at what has happened to the market since then. The Nasdaq's up 22%. The S&P 500's up 16%. Oh, baby, okay? And so when you see something like that, you got to ask yourself, and remember, the market had been falling and falling and falling until it finally bottomed out it was around early to mid-October, right? You got to ask yourself, like, what comes first, the chicken or the egg? Is the only reason people are starting to turn bullish now because the market's just doing so well? And so now people are flipping over the bullish side? And why was everybody so bearish back in September, October? Was it just because the market and the Nasdaq was down like 37% peak to trough? Is that what pushed everybody down, right? The chicken or the egg, what really came first? And you look at some of these moves, it's insanity, man. I mean, absolutely the most insane moves. Coming off the most insane moves last year. I mean, many of these stocks went to valuations I couldn't even conceive of. Like what this stock is. Meta's a perfect example. In Q4, it fell to $88. That was shocking. Simply shocking. Like I never imagined Meta even going under 150. Never mind under 100. It's ridiculous, okay? And now look at that stock. Today it's $200 and almost $65 a share. And that's just since Q4. And remember, we're still in Q2. We're still in Q2 right now of 2023. That's insane to think about, right? Tesla's Q4 low was what, $101? It kind of looks like laugh out loud because a Tesla at $100 is like a laugh out loud price, right? Today we're at $244. Here we are, toward the end of Q2 of 2023, right? Amazon went all the way down to $81. It's $123 here today. Palantir was what, $6 in Q4? And it's 15 now, right? So the moves have been very dramatic, but something very important to understand is it's not the whole market, folks. There's certain stocks in certain areas are doing tremendous, and a lot of things aren't doing good. It's not like we're in some raging bull market. Just factually, we're not, right? Consumer staples are down this year. Energy's down this year. Financials are down this year. Healthcare is down this year. Materials and industrials are trying to eke out little gains. Real estate's like barely up for the year, and utilities are down for the year. So this is not an overarching like massive bull market that lets push up all assets, all sectors, all stocks like you've seen in many past years, right? Now, next thing that's very important here is check out the fear and greed index. We are now in extreme greed. We are now at a 77. Let that sink in for a moment. 77, folks. So, obviously the market's gotten greedy. Now, if we look at market momentum, we're in extreme greed for market momentum now at this point in time, which, I showed you how the market's done this year, and specifically since, around September, October last year. Naturally, market momentum is going to be pretty greedy, okay? Stock price strength is in greed territory right now. Stock price breadth is now in greed territory. And this was one of those things that a lot of the bears were still pointing out, like, well, it's a few stocks, but a lot of these other ones aren't doing well. Well, recently, now breadth is starting to come around in this market, right? This might be the most important thing in regards to this whole segment of the video before we get to the other part, okay? Put to call ratio. We're at a point in time now where people are getting so much less bearish that they're becoming not very interested in buying put options, okay? And so whenever this ratio is at a 1, basically that's even. Now, the market in general goes up. So naturally, there should be more people playing calls and puts. So naturally, this number should be under 1 most of the time, okay? But when people get very bearish on the market, it actually goes over 1, which means people are playing heavy puts, right? And you can certainly look back going into this year, a lot of people playing put options heavy. Certainly, this is around SVB time, regional banking collapse. A lot of people playing puts very heavy during that point in time, right? Obviously, right here, remember, we just looked at when the market was the most bearish we've seen in the past year, and actually around the most bearish we've seen since the great financial crisis, right? That was back in late September going into October, right? And look at how many people were playing put options. There was overwhelming amount of people playing put options, right? So the market had gotten extremely bearish, right? But now at this point in time, clearly people have gotten a lot less interested in put options, and they're getting a lot more interested in call options, right? Which is why this number is going down and down and down. If you ever see this go, below 0.7, then you're really talking, people are really in a bullish standpoint, right? If you look at something like the VIX is dead, and it's desensitized, right? It's so hard to shake up the bulls nowadays because the bulls have been through so much. I mean, the bulls have been through so much just in the past few years. It's so hard to shake bulls. You talked about Rona, the worldwide economy closing. You talked about, the first major conflict in Europe since WW2, right? You're talking about the highest inflation we've seen in, a generation, if not 2 generations, right? You got to go all the way back to the 70s to see the type of inflation we've seen recently. And so when you talk about all that, right, the Fed raising rates at the fastest clip they've ever raised rates in history in terms of a percentage up, right? When you get all that thrown on investors in a 3-year span, investors start to become desensitized. They start to become not very fearful. It takes so much to really shake out and shake up the bulls to make them say, you know what, I got to cut my whole portfolio. It's so hard. There's a certain amount of weak hands in the market, as they call them, right? But to get the people that have been in this market 10, 15, 20, 25 years that are bulls, to get them to really shake out of everything is so damn difficult now at this point in time because they've just gotten very desensitized. So to get the VIX to really pop in a major way has become very, very difficult, right? If you look in the past year, the VIX is down 50%, which basically means there's just no volatility in the market whatsoever, folks. And so that's the market we're in right now, okay? Now we're going to talk about how to position your portfolio moving forward. We're in a market where the VIX is dead. It's completely desensitized. We're in a market that it's looked past everything that was going on bad. And now we got some actual bullish shoots that are starting to emerge. And sentiment's just gone to the bullish side. And keep in mind, when you flip sentiment over to the bullish side, many times you're going to remain over there for many months or potentially even years, depending upon how long of a bull run you had, right? That depends upon many various things. So how long does this bull ride last? I don't know. I can tell you this. A lot of fund managers are still underweight. So they've got to chase the indexes in the second half of this year. So really there's a lot of fund managers that they need this market to go down so flippin' flapjack and bad. And if they don't get it, what they're going to have to do is they're going to have to position more into stocks, which is going to push up valuations even more. Okay. All right. Now let's talk about some very important subjects now that we have that all out of the way in regards to your portfolio. Okay. So insurance, right? Insurance. We all have different types of insurance. If you rent somewhere, you probably have what's called renter's insurance, right? So if everything catches on fire, you're protected from that. If you own a home, you might have homeowner's insurance, right? If you own a car, you have car insurance. You might have health insurance, and hopefully you do, right? And the reason we have these different types of insurances in life is so in case things go bad, right? And you need, a $50,000 procedure at the hospital, which isn't spending in that much nowadays because healthcare is out of control, right? Or if your house burns down or whatever happens, right? You're protected. And that's great. But the problem is most people don't protect their portfolios at all, okay? They don't protect their portfolios at all. And I bet you a lot of you guys watching this video right now, I bet you're not protected. Do you have insurance on your portfolio? Probably not. And I didn't do it for a long time either. And then I got bitten bad. And I hurt severely, right, in 2022. And that really changed everything for me. And I realized I'm riding around like a cowboy with no insurance, and this isn't good. Same way as somebody that never wants to get home insurance or, car insurance, and then something bad happens, they get in a car accident, and they realize, oh, this is why I should have it, or no health insurance, and then something happens and you're like, oh crap, I wish I had health insurance right now. Or your house burns down. You got, the million different things. You don't look at it until you really need it. And that's the moment that you start taking it serious and you're like, damn, man, I freaking need some insurance, right? So there's a lot of different ways of kind of playing insurance in your portfolio and adding to protection for downside. So if there's a downside scenario, over the next 6 months, 12 months, 18 months, you're at least somewhat protected, okay? And so let's go over a few different ways you can protect your portfolio. And there's a million different ones, okay? Because I understand, most people don't want to sell out your portfolio. It's not worth trying to time the market, right? Don't time the market. Don't try, I've seen a lot of really intelligent people, if we want to call them that, try to time this market and sell out all their stocks just to then watch their stocks go up and up and up and turn into perma bears. You don't want to have that happen, okay? So if you want a little protection out there to a little slice of your portfolio, you can buy what's called SQQQ, okay? ProShares Ultra Pro Short QQQ seeks daily investment results before fees and expenses that correspond to 3 times the inverse, -3 times the daily performance of the NASDAQ 100 index. So if let's say you're of the thought process like, oh man, NASDAQ stocks are starting to get really expensive. I think there's a lot of risk out there. I think there's at least a potential that we could have the market go down over the next 6 to 12 months. And I want to protect myself a little bit just in case that happens. You can buy a little bit of SQQQQ, okay? And if you look at the performances like the past 5 days, for instance, it's not always perfect, but it's pretty darn close, right? The Qs are down 0.24% in the past 5 days, and SQQQQ is up about 0.7% roughly. So it's never going to work out perfect in terms of a 3x correlation, but it's pretty darn good, at least over, shorter periods of time of, let's say, a few weeks, a few months, something like that, okay? So that's something that's a potential, and that's something I actually might have just bought my first SQQQ in my life in terms of a little small hedge today. I might have, I don't know. Check out the Patreon portfolio. I made 5 moves in the Patreon portfolio here today. That's pinned comment down there. You get to see the moves I'm making each week in there, okay? Next one up here that you could do is SDAO, right? SDAO is basically, think of it as SQQQ, but the only difference is this one's basically working against the Dow Jones Industrial Average, right? And so this one's 3 times inverse of the daily performance of the Dow Jones Industrial Average. So those are 2 options you certainly have out there, right? That are ways to protect your portfolio that you can with a smaller amount of capital, right? You can do that with 1% to 5% of your portfolio, which is not a huge percentage, but obviously if the market goes down immensely, you're going to save a lot of face in that situation because remember, it's working as a 3x. So let's imagine a scenario where, you put 3% of your portfolio in SDAO, let's say, for instance, right, or SQQ, and let's just say the Dow goes down 10% over the next 2 months. People start getting scared again, the market's overvalued, whatever, okay? Then all of a sudden, obviously you're going to likely 3x your money, if not a lot more than 3x your money, because obviously, in terms of the performance of SDAO, if it if the Dow's dropping rapidly, very quickly, it's potential the S Dow could actually do a little better than like 3x against the market, okay? So that is something to keep in mind there. If you want to take it on steroids a little bit and maybe risk smaller amount of capital, then you can look at something like call options on these things, right? So let's say you're NASDAQ heavy and you're like, I just want to hedge up, buy a little insurance in case this market goes down in any significant way. You can look at actually buying call options. Let's say you're thinking about 6-7 months out, January 2024. And you could be looking at a few different strike prices here. So you don't have to just buy one strike price. You could buy something in the money. Remember, SQQQ right now is just under $22, right? So you could buy something, pretty far in the money right now. That's like, let's say at an $18 strike that's expiring in January 2024. You could buy something else in the money that's like a $20 strike price. You could buy something a little out of the money, so like $23 strike price. And you could buy something like $30 just in case the market really tanks, right, in a major, major way. That would obviously be a huge moneymaker if the NASDAQ obviously tanked off a cliff the next 6, 7, 8 months for whatever reason, right? So that's definitely a way you can play it. And like I said, you don't have to go all in just one thing, because a lot of people think, oh, I just got to buy one. If you're trying to buy protection, you can buy it at several different prices, right? And that's the way to think about it. And the way to think about all this, right, in terms of insurance, it's no different than most of the time you're going to pay in for your car insurance. Most of the time you're going to pay in for your homeowner's insurance, and you're not going to use it, right? So you say, it's a waste of money. Well, no, it's there in case of worst case scenario. Most of the time you're going to pay into your health insurance, and you're not going to use it. That's a good thing. And so the way to think about this, whenever you're hedging your portfolio, you're not going to use it, or hopefully whatever you're buying is not worth much in 6 months or 12 months from now, because that means the market likely went up, which means your portfolio likely did tremendously well over that time. But just in case it goes really bad, you get to save a whole lot of face, and you're going to be very, very happy you did that, right? Now, let's say there's a scenario where you're like, well, I'm not that worried about the next 6-7 months, but I am worried about 2024 in a substantial way. Well, over this next few months, you could look at something like January 2025 calls in regards to something like SQQQ, right? And you could look at something in the money like $18. You could look at something also slightly in the money at $21, and then something out of the money at like $28. Do keep in mind, if you're going to push out the date like that, right, you're going to have to pay a bigger premium. That's just a bottom line with that, right? Because now you're playing with even more time. If you're playing with more time, you have more time for things to work out in that direction, right? If it's going to work out that way. Another way you could kind of play this if you want is basically buying call options on the VIX. So if the market's going to tank in a massive way over especially a shorter amount of time, the VIX is almost always going to spike, right? And spike huge. The one thing I'll say about the VIX, okay, and I don't think it's a bad strategy from time to time, but I got to say, damn, it's expensive right now. If you look at like something like January 2024, it is so freaking expensive. And I think because a lot of people have hedged their portfolios buying things like call options on VIX. I mean, check this out here, folks. If I want to buy a $14 strike, right, which is just barely slightly out of money, for January 2024, I'm going to pay almost $8 for that. So I need the VIX to pop to 22 roughly just to break even. That's to break even, folks. That's not to profit, that's to break even. That's vicious. This is very expensive right now, okay? If we look at like $27 strikes, which would mean I need the VIX to basically 2x from here, I still got to pay $2.50 to $3 for those. What? Like, that's a lot. So this isn't a bad strategy sometimes if you want to hedge your portfolio. It's just a damn expensive strategy right now. I can tell you that much. It's insane. Absolutely insane. Another way you can hedge your portfolio if you want is you could just buy put options on the S&P 500, SPX, okay? Now, the great thing with this is I can tell you there's so many different dates. I mean, pretty much the most dates you could possibly imagine in terms of however far out you want to play it. You could play it February next year or March, or almost every single month and even almost every single week. You have different dates that you can play if you want to buy puts on the S&P 500 if you want to protect that way, right? And so the way you could look at something like this, right, is right now SP 500 is around 4,300. So you could buy some 4,300 strikes. You pay about $154 a premium for those. You could buy something at 4,200, right? Something at 4,100 and something at 4,000 in terms of strike prices on those. So those are just some concepts in possibilities that you could implement in your portfolio. There's another strategy I can also show you here that I think some of you might be into, because some of you guys might be like, it's a little confusing. By the way, if you got confused by any of this, watch the last 5-10 minutes of this video over again and just watch it until you get it, okay? That's what sometimes you got to do. But the next strategy is a more simple strategy. If you're like, I don't know about doing these options and things like that, that might be a little much for me. Well, there's another way to kind of hedge a little bit. It's not quite to this extent where you're going to make a bunch of money, right, if the market goes down big, but it is, I look at it as a way of kind of hedging your portfolio a little bit. So let's say you usually put $1,500 a month into your portfolio, right? And for those of you that can do that, congrats. Good for you guys. So let's say you usually put $1,500 a month in your portfolio. What you could do is you could say, well, instead of putting $1,500 a month, I'm going to start putting $1,000 a month because I feel like the market's getting a little rich or some of these stocks are getting a little overvalued, if that's the way you feel, right? And then you can say, I'm going to put an extra $500 to savings. Now, what that does is over the course of the year, right? Let's say, or let's just say over the next 6 months. Let's say the next 6 months, you feel like the market's trading rich, you got some opportunities, but you're not seeing as many opportunities over the next 6 months. So, over the next 6 months, you save yourself an extra $3,000 of cash around, just in case the market goes down in 2024 or something like that. You got extra savings around to go ahead and take advantage of deals out there in the market. So just another way of kind of hedging, but this one's just, like I said, you're not going to capitalize if the market goes down huge like you would in some of these other strategies we're going over. And by the way, I could spend an hour, 2 hours just going over different hedging strategies. I did last month, I think it was, I did a very in-depth, like 45-minute video for the private group, all different hedging strategies you can have out there. And it's insurance for you, just in case things go bad, right? You never know. And it also lets you invest more freely, because once you have insurance, you don't have to live life in such a fear mode of like, oh my gosh, if the market goes down, I'm so screwed. Any market, I'm set. Bear market, I'm set. I got several hedges on the market that are print money if we go into a major bear market and the Dow and S&P, NASDAQ all go down 20-30%. Market goes up, I'm set, right? Hundreds of thousands of dollars more, millions of dollars more I'll be making. Kangaroo market, great. I love kangaroo markets. That just gives me a longer time to buy assets at very undervalued prices. So regardless of market, I'm not scared. If you're all in the market, only on the bullish side, you need this market to keep going up, and you're gonna, maybe have a little trouble sleeping at night because if this thing goes bad, boom, you're hurt and you're damaged substantially, obviously. Okay, so I appreciate everybody joining me as always, folks. Make sure you get in my Patreon. If you're not in my Patreon and you enjoy the content, you think it's valuable I put out, then check out my Patreon. It's pinned comment down there, and I go over running that portfolio, my hedges I have on, and the stocks I'm buying, all those sorts of things. By the way, somebody's lucky dogs. My man who helps me run the Patreon, he's getting married here today, so congrats to him. But this is supposed to always be closed down, but there's like 7 spots open right now, and he's getting married, so I don't want to bother him and be like, hey dude, can you close that down? That's a little awkward, and I don't know how to do that crap. So otherwise I'll probably end up kicking everybody out or something on accident. So appreciate you guys joining me. Much love as always, and have a great day.